Welcome to the rate model presentation for the transportation and warehouse industry. My name is Philip Germain. I'm the Vice President of Prevention and Employer Services at the Workers' Compensation Board. Like I said, I'd like to thank everyone who came to be here in person today and all of those joining online. We appreciate it. What we're going to share with you today is the impact of the implementation of the enhanced rate-making model, which will come into effect for the 2018 premiums. We've made a decision not to implement the model for the 2017 premium rates because, as you'll see, some of the impacts of the changes are fairly significant on some of the industry sectors. Our board administration felt it was important that we provide the opportunity to provide educational sessions related to what is exactly changing and how that might impact specific rate codes. So what we're going to show you this morning is not the 2018 premium rates. We're not going to attempt to guess at that just because we don't have all the data to determine what the 2018 premium rates would be. So we'll show you a comparison between the 2017 rates as they're currently calculated and published compared to what the rate would have been had we implemented the enhanced model for 2017. Presentation is scheduled for 2 hours, roughly an hour for the actual presentation itself, and then we'll leave an hour for questions. And those online can submit questions, and we'll answer those at the end of the presentation. So the agenda for today is we're going to start with a background on the workers' compensation system, how it came to exist, and a high-level overview of how premiums are set. Then we'll go into the purpose of the rate model review, the impact of those changes, and what would have been the rate had we implemented it, the impact had we implemented it. And then we'll end with kind of what are the next steps. So let's start with the background. Prior to 1915, there were no workers' compensation systems in Canada. Workers seeking compensation for injuries that occurred on the job had only one option: to sue their employer. Most cases for workers were not successful. In fact, most workers didn't have the resources to sue their employer. But when a worker was successful, it often meant the demise of the employer, forcing them into bankruptcy. Neither of those situations are very beneficial from an economic perspective. The Ontario government of the day began to notice fairly dramatic increases in the use of their social security systems because workers, in the absence of a work injury insurance program or the ability to sue their employer, were left without any way to pay for medical or to earn a living. These workers ended up on social assistance, elevating the cost of those programs, so the government, recognizing this, appointed a gentleman by the name of William Meredith in 1913 to study the issue and come up with an alternative solution to the current system. Meredith came up with this notion of creating a workers' compensation system. The approach that he took is often referred to as the historic compromise. The compromise meant that workers gave up their right to sue in exchange for medical and wage loss benefits, and employers assumed the cost of the system in exchange for protection from legal action. All jurisdictions across Canada adopted the model, and each has its own workers' compensation legislation. It's evolved over the years. However, the 5 principles upon which it was designed continue to form the foundation of compensation systems today. Those 5 principles include no-fault compensation, which means workers and employers are paid, benefits regardless of how the injury occurred. The worker and employer waive their right to sue. There's no argument over responsibility or liability for an injury. The second principle is security of benefits, which means there's a fund established to guarantee that there's money to pay for the benefits related to work injuries and claims. The third principle, which is an important principle for all insurance programs, is collective liability, which means that covered employers, on the whole, share liability for workplace injury insurance. The total cost of the compensation system is shared by all employers. All employers contribute to a common fund. Financial liability becomes their collective responsibility. Collective liability is common to all insurance programs. And so if you think about even your house insurance as an example, your house insurance is based on the collective experience of people with similar types of homes, risks, whether or not you have fireplace, whether or not you have an alarm system, do you live in a floodplain or tornado alley. All of these risks get factored in, and people with common risks contribute to a common pool, and if something happens, your house burns down, the insurance pays for the replacement of that home. You don't pay for it yourself. So that's another example, just like workers' compensation, of collective liability. Share in the responsibility of the costs associated with all claims. The fourth principle is independent administration, which means that the organizations who administer workers' compensation insurance are separate from the government. And the fifth and final principle is exclusive jurisdiction, which means only workers' compensation organizations provide compensation insurance, workers' compensation insurance. All compensation claims are directed solely to the Compensation Board, and the board is the decision maker and final authority for all claims. These 5 principles remain valid today and support an effective compensation system. So what's the process by which we actually determine an employer's premium rate? There's 3 basic steps that establish the amount of premium that an employer would pay. The first one is industry classification. In Saskatchewan, there's roughly 47,000 employers registered with the WCB. We take those 47,000 employers and we group them into what we call rate codes, based on their primary business activity. So you can think of a rate code as a risk pool. There are 50 rate codes, and so 50 different industry groupings. Employers involved in similar business activity or risks are placed in the same rate code. So for example, we place all employers involved in trucking as their primary business activity into the T42 rate code. I think it's T42. So all employers in that rate code share in all the costs of all the claims that occur for all the employers in that rate code. The same is true for all industries. So bankers are grouped together, healthcare are grouped together, construction, residential construction's grouped together. The premium rate is determined at the rate code level. So the base premium rate is determined at that rate code level. The second step is the process by which we determine how much we have to collect in premiums. And we go through this, really the bulk of the presentation is related to this step, step 2, in terms of how we determine the collective experience of a rate code and the costs associated with that collective experience. So after the second step, we arrive at what we call the base industry rate. So every employer in a rate code would start off paying the same base premium rate, but recognizing that individual employers in that rate code might have different experiences. So to hold individual employers accountable for their own experience, we introduce something called experience rating. And there's 2 streams to that program. The standard experience rating program is designed for smaller employers who pay us less than $21,000 in premiums over the previous 3 years. The program is frequency-based, so it's based on the number of time loss claims you've had. Depending on the number of time loss claims, you may be eligible for a maximum discount of 25% or a maximum surcharge of 75%. The second program is the advanced program. So the advanced experience rating program is for larger employers that pay us $21,000 or more in premiums during the previous 3 years. This program is cost-based. So it's based on the cost of claims, not the number of claims you have. And if your individual claims experience is better than the average for your industry, you would be entitled to a maximum discount of 30%. If your experience is worse than the average for your industry, then you would be subject to a surcharge to a maximum of 200%. So to recap, employers are placed in rate codes based on their primary business activity. We calculate the industry premium rate based on the collective experience of all the employers in that rate code. And finally, we apply experience rating to individual employers' experience to determine the final premium rates that you would pay. So the purpose of the rate model review. So why did we undertake a rate model review? The rate model review came about as a step in the review of our overall financial system. So as part of the overall review of our financial system, we started by looking at the way we invest funds. So when we established premium rates for 2017, we were seeking to establish the premium rate that was necessary to collect today for all the costs of claims that would occur in 2017. Now, we don't pay all those costs in 2017. So a claim that occurs in 2017 may have costs well into the future. We could pay as long as 50 years on a claim. So if you have somebody quite young, because our benefits will go to age 65, if you have a 14, 15-year-old that's severely injured, we could pay some type of benefits, medical, wage loss, something on that claim to the age of 65, which would be up to 50 years. So we're trying to estimate the costs for the claims that would occur in 2017 as far out as 50 years and collect the present value of all those costs today in that premium rate. Because we're not spending all that money, we invest those premiums. And those premiums are expected to earn a certain rate of return in order to fund the future costs that we would have to pay. It's kind of like a pension. So we undertook a review of our investment policy, which is the way we allocate our investment funds into various different asset classes that are available. Things like equities, bonds, real estate mortgages, etc. And following the review, we undertook something called an asset liability study, which simply seeks to look at how closely we match the incoming of our investments with the cash flow requirements in order to meet future payments. So the money that we invest, do we have enough money coming in to make sure we can meet all future obligations of claims that occurred within that year? So we have to achieve a certain rate of return that is assumed in the calculation of the premium rates in order to have sufficient funds to pay those costs. So part of the asset liability study was to see how closely our assets matched our liabilities. And during that review, the actuary that we hired, a firm called Eckler, suggested that we should probably review our rate-making model because it is an integral part of the revenue generation stream that we have. So do we have enough money? Are we calculating the right premium amount? So that was the first major reason. Out of the review, the asset liability study, Eckler suggested we should look at our rate-making model. And part of that is we hadn't looked at the model for quite some time. But secondly, we were hearing from employers, particularly in recent years, that the rate model was not reactive enough to changes in the experience of industry. So for those two reasons, the board asked us to undertake a review of the way premium rates were established, which is really step 2 in that rate-making process. So what we sought to do in reviewing and enhancing the rate-making model was to balance these often competing principles that are within that model. So on the one hand, we want to ensure that industries are held accountable for their own injury and cost experience. On the other hand, we want to make sure we maintain collective liability as part of collective liability to ensure that employers and rate codes are not unduly burdened by extremely expensive claims. So one of the key principles of collective liability is that if an industry has a really expensive claim, that all employers would share in the cost of that. Just like if somebody's house burnt down, that's a pretty expensive replacement cost. All homeowners share in the cost of replacing that individual's home. So if we increase accountability of the rate code, we decrease collective liability, and vice versa. So what we're really trying to balance those competing principles. On the other hand, we understand and recognize how important it is for employers to have some stability in their premium rates so that rates aren't seeing dramatic increases or decreases from one year to the next. We seek through the rate-making model to generate rates that are quite stable. But at the same time, we balance that against reactivity in the model. So if we make the model too reactive, we create volatility in your premium rates. They start bouncing up and down. If we create too much stability in the premium rates, we withhold reactivity in the model and don't recognize the current experience of the industry. So in the rate-making model, we are really trying to balance these 4 principles that underlie the model in the most transparent way possible. So what was critical to the review process? Some of the things that we were thinking about as we went into the review process. And fundamentally, what we're really trying to do, as I'd indicated earlier, is to predict how much revenue we have to generate through the premiums in order to pay for the costs of the upcoming year's claims. So we're anticipating that at an average rate of $1.24 in 2017, that money is going to be sufficient to pay for all the costs associated with all the claims that occur in 2017. So in conducting that review, we wanted Eckler to look at the credibility of the model from the perspective of how accurately we are generating the amount of premium revenue that we would need to fund the system, no more, no less. We also wanted to make sure that the model is fair and equitable to all employers and that it be actuarially based, meaning we take a very scientific approach to establishing premium rates while maintaining principles like fairness and equity. So what were the key findings of the Eckler review? If you're interested, the actual report of both the asset liability study and the rate model review are on our website. You can download them, look at them. There's a lot more detail in those reports than what I'm providing. So if you're interested, both of those reports are on the website and available. So what Eckler actually determined is the process for determining the premium rate at the board level is sound and works well for generating the revenue requirements Now, when I say board level, I'm going to use the term board level and board level experience. And what I'm referring to is the collective experience of all employers in all 50 rate codes within the Saskatchewan WCB system. So what Eckler determined is the current model works well in predicting the future costs and premiums required to fund those costs. But what Eckler found, however, is that it needed some refinement because it's not doing as good a job when you get down to the individual rate code level. And quite frankly, over the years, they found as a result of changes in the economy, in improvements in injury prevention, some of the principles like accountability and reactivity had deteriorated and required us to intervene in order to maintain things like rate stability and reduce volatility in premium rates. Eckler made 7 recommendations, and I'm going to talk about each of those in some detail. However, I want to cover off the second one, which is classification right now. What Eckler noted was that in Saskatchewan we have 50 rate codes, and that some of those rate codes are quite small. In fact, some of the rate codes have less than 20 employers in them. It's very difficult to predict future claims costs in small rate codes. For example, just as an example, if we were to conduct a survey of everyone in this room, but I only use the results from one person, right? That wouldn't be enough information to represent everyone's views on a certain topic or question for the room. So what's happening in these small rate codes is there's just not enough claims, costs, or experience to accurately predict future costs. So what Eckler noted is that we probably should develop, we don't have a process to systematically review the classification system or rate codes. Eckler suggested that we ought to build a process that would require periodic review of the classification system with the thought of perhaps merging some of the smaller rate codes with other rate codes to create a larger sample size that would actually enable us to credibly predict the future experience of a rate code. What the board has decided is that they would like us to build that process for regularly reviewing the classification system and rate codes. But in the meantime, there are no immediate plans to review the classification system or merge any rate codes. Any process that we would build to review rate codes or the classification system would require a fair bit of analysis, and it would include consultation with industries that are impacted by any change. So there are no immediate plans. We're going to build the process, do some analysis, and at that point, if there's a need to come out and start talking to certain rate codes, that's where we would start. Because invariably, if you're going to merge 2 rate codes, the odds of them having the identical experience and premium rate is pretty slim. So the perception would be there could be winners and losers if you're merging 2 rate codes. And we'd need to be talking to industry about that. So before I get into the details of the other elements of the rate model recommendations, I just want to reinforce what we're going to show you in the next few slides are the industry impacts on your particular rate codes in the T class. Had we implemented the new model for the 2017 premium rate compared to the existing model? Again, we don't have information to show you for 2018 as a comparison. We don't have the 2018 premium rates simply because we don't have all the data yet to establish the 2018 premium rates. So what you're going to see is simply a proxy for the order of magnitude that you might be impacted by as a result of these enhancements to the system. The 2018 rates will be released in the fall and will include these enhancements to the model itself, plus any updated injury experience for your rate code. So let's look at the recommendations one by one and the impacts had we implemented. So the first recommendation Eckler made was related to a concept called credibility. And it very much refers to what I was just talking about from a classification perspective. Credibility refers to the reliability to use historic experience in predicting future experience. So to the extent that you have a large enough sample size that is representative of what the future might look like, it can be reliable. But in the case of extremely small rate codes that don't have enough history or experience built up, just because there's not enough employers or claims activity, it's really hard to accurately predict what future claims costs would be. So under the current model, what we've done in order to mitigate this issue of low credible rate codes is that we've been adjusting that experience at the rate code level for low credible rate codes by blending it with the board experience, all 50 rate codes. So what that helped to do was increase the reliability of the experience in those small rate codes. Eckler said that that's not really what we should be doing because it doesn't hold the industry code very accountable for their own experience by intervening, by applying that board level experience to the individual rate code. But Eckler did recognize that you have to have sufficient experience in order to predict and make a valid prediction of costs going into the future. So under the current model, for all industry rate codes, we calculate the average costs of claims that are paid in the last 5 years, except for medical costs. We only look at a 3-year window for medical costs. All other claims costs are a 5-year window. So for 2017 premium rates, we used the 5 most recent completed injury years. So that'd be 2011 to 2015 in establishing the 2017 premium rate. All costs paid in those 5 years are added together and a 5-year average is calculated. And that 5-year average is used to predict what 2017 experience might look like. Again, under the current model, we would calculate the average and we would adjust it upwards or downwards depending on the overall injury experience for the 50 rate codes taken together. Eckler said that we could continue to fundamentally maintain that underlying principle, that we will use historic averages to predict future experience. However, Eckler said if the rate code was too small, that we shouldn't just limit it to 5 years experience, that we should expand it to 10 years experience for those non-credible rate codes. So for an industry code that is credible under Eckler's definition of credible, is a rate code should have $16.5 million in claims costs flowing through it over 5 years. So if you have $16.5 million or more in claims costs flowing through your rate code over the previous 5 years, your rate code would be considered 100% credible. And we would use that 5 years experience as a reliable way to predict future costs. But for rate codes that fall below 100%, so less than the $16.5 million in costs, then we would need to blend a 5-year average and a 10-year average of the industry's experience. So if a rate code, let's say, had $10 million in claims costs running through it over the last 5 years, we would consider it 60% credible. The other 40%, we would use a 10-year average. And we would combine those two averages. The 5-year average, we'd take 60% of the 5-year average, 40% of the 10-year average, combine them to come up with the prediction of future costs for that rate code. So now we're not combining experience at the board level, we are only looking at experience within that rate code. But we're approaching it differently so that low credibility rate codes can be considered more credible in predicting future costs. So generally speaking, because we adjusted all the experience for low credible rate codes with the board experience, if your rate code experience was worse than the board, so by us not blending your rate code experience with the board level experience, and by just looking at your industry's experience over the 5 or 10 and/or 10-year period, if your experience was typically worse than the board experience, that would cause your rates to increase under the new model. If your experience is better than the board level average, this would have the effect of reducing your premium rate. So how would this impact the T codes? So under T42, it's currently 89, under the current model, it's 89% credible. Their experience for T42 is very similar to the board experience, so there's no impact by removing that blending of experience. Under the enhanced model, the new model, the rate code becomes 100% credible. So we're only going to look at 5 years of costs. The change, and if you recall, I said we look at 5 years claims experience except for medical, 3 years. But under the new model, we just look at 5-year window of all costs. The change of going from a 3-year window to a 5-year window for medical and vocational rehabilitation costs is actually what's causing this downward, this reduction in this element of the premium rate. So it would have gone down 5 cents for this element of the premium rate in T42, simply because what we're predicting is the average cost for medical is going to be less than what we were predicting under the old model. T51. So T51, which is operation of railways, and by the way, T42, for those that don't know, is trucking, courier, and commercial bus. T51, operation of railways, currently is 45% credible under the current model. Their experience is worse than the overall board experience. So by removing that blending of experience, it's going to cause costs, the premium rate, to go up. Under the enhanced, the new model, it now becomes 50% credible. So we got to blend 5 and 10 years experience. And the 10-year costs are actually higher than the 5-year costs, which again are going to increase costs. The combine of those two impacts would be an increase, had we implemented this in 2017, an increase of 19 cents for this element of the rate model. Now, I just want to warn you, as you're seeing these numbers bounce up and down, you're going to see numbers going up and down across. So there's going to be puts and takes through this whole model. There'll be a net impact to that at the end. So you're not likely going to see everything going up or everything going down as we go across here to each element of the rate model. T61, which is commercial air transportation, under the current model was 32% credible. Its experience was worse than the overall board level experience. So by removing that blending of experience, it's going to cause the premium rate to go up. Under the new model, slight increase in credibility to 36%. So now we've got to blend the 10-year experience and 5-year experience. And again, their 10-year costs are higher than their 5-year costs, which again has an impact of increasing costs into the premium rate. The combined effect of that would be a 6-cent increase in this element of the premium rate. Oh, there we go. The next recommendation that Eckler made has to do with the use of indicators to predict future costs. So I already told you that we use a 5-year average to calculate what we expect in terms of spending in the future. As part of determining future costs in the existing model, we would try and forecast the number of time-loss claims. And then we'd attach an average cost per claim to the forecast of claims to determine the future revenue requirements. The problem with that is that in recent years, we've seen significant decreases in both the time loss and total injury rates and decreases in the number of total claims. However, the costs of claims have not seen a corresponding decrease. In fact, we've seen some increases. So using the time loss claims counts as an indicator to the way costs might move is no longer valid because there's no positive correlation anymore between how costs are moving and how the number of injuries are moving. Claims are on a steady decline, costs are on a steady increase. What Eckler said is that you need to stop using the number of time loss claims as an indicator of what the future costs might be. He suggested that we stick to our 5 and 10-year averages. So for credible rate code, we use 5. For a non-credible rate code, we use a blend of 5 and 10-year average. We would augment that by the change in the workforce. Change in the workforce simply means the percentage of change in the number of workers covered by that particular industry code. When we graph the change in costs with the change in workforce, we have a very strong correlation. It's about 97% positive correlation between the change in workforce and the change in costs. It validated what Eckler was saying, that the movement in costs has a high correlation with the movement in the change of workforce. Conversely, in recent years, the correlation between costs and time loss claims was actually negative 88%. Really no correlation at all anymore. There's just a number of factors. When we implemented time loss claims, the average cost of time loss claims and the number of time loss claims in the 90s, it mapped costs very well. Over the last few years, it's just not correlated anymore. So we accepted the recommendation and we will no longer use time loss claims to predict future costs. We will rely on the change in workforce to adjust the 5 or 5 and 10-year average in costs for that rate code. So if we see a 5% growth in workforce, we're going to assume the average cost of claims will grow by 5%. Because of the volatility in some of the premium rates, we were blending the current year's premium rate with the previous year's premium rate, basically averaging the two. So for whatever the model would spit out for 2017, we would have averaged that with the 2016 premium rate and charged you that amount. So what we're charging you today is a blend between your 2016 premium rate and your 2017 premium rate in order to remove the volatility of the rates and because of the lack of reliability in the model. Because of that negative correlation between time loss claims, you would assume if time loss claims are going down, costs should have a corresponding decrease. Because that wasn't the case, we were underestimating the amount of costs within each particular rate code. So the blending made sure that we were bringing in enough revenue to cover off the costs of all the claims for this year and into the future. So, what would be the impact of going from time loss claims as an indicator to workforce as an indicator of the way costs are going to move? In T42, time loss counts have generally been decreasing over the last 15 years, which means that using time loss claims caused the rate model to expect corresponding decreases in costs. using workforce will cause the rate model to expect increases in liabilities that are in line with the growth of this industry. Therefore, the adoption of workforce as an indicator of costs would actually have caused T42's premium rate to go up by 7 cents. But the current model was blending this year's premium rate with last year's premium rate. By stopping that blending, will decrease the premium rate by 26 cents. So the combined effect of those two changes would see a 19-cent decrease in this element of the premium rate had we implemented in 2017. T51. Similar type of experience. From 99 to 2015, time loss claims counts have been decreasing in this rate code. So this means that we would have been underestimating costs. But while from 1999 to 2015, the size of the workforce has also been trending downwards, faster than the decline in time loss claims counts. Therefore, the adoption of workforce as an indicator will decrease T51's premium rate by 11 cents. And then the removal of the blending will cause the premium rate to decrease an additional 13 cents. The combined effect of that is a decrease in this element of the premium rate for T51 by 24 cents. T61. Again, time loss claim counts for T61 have been decreasing since about 2009, which would have caused us to underestimate the cost of claims. Using workforce will cause the model to expect an increase in claims liabilities that are in line with the growth of the industry. The adoption of workforce as an indicator would have no impact. The changes between those two pieces, the underestimation of claims costs because of the decrease in time loss claims and moving to workforce, those two forces kind of have an opposite effect. The net effect of that, moving to the enhanced model, is 0. But the removal of the blending is actually going to cause this element of the premium rate to go down by 8 cents. The next recommendation that Eckler made, that the board accepted, relates to the costs of relates to costly claims pooling. So as I said earlier, collective liability has two basic elements to it. The first, that we are collectively responsible for all the liability or costs associated with all the injuries that occur in your industry. The second element is that individual employers should not be unduly burdened by excessively expensive claims. Under the current model, we have a claims cost capping element to it, but it's limited to something we call pension costs. And when we talk about pension costs, we're talking about long-term claims that have some element of permanent loss of earnings. And in most cases, continue on to the age of 65. So it's not pension in the way we typically think of pension. It's pension in what we call pension is long-term earning replacement. Somebody's severely injured, can't earn their full wage, and so whatever we're paying them over the long term for earnings replacement is what we would call pension. Under the current model, if the cost of pensions related to an individual claim in a specific rate code exceeds $90,000, we cap those costs at $90,000, and the difference between the $90,000 and the actual cost for that pension gets spread across all employers in your class. So the T class represents all employers who are in rate codes that start with T. The T class represents it's the transportation and warehousing sector. So the class is called transportation and warehousing. So if an employer, for example, in T42, just as an example, had a claim with a pension-related costs that were $150,000, we would cap the costs at $90,000, and the other 60 would be distributed to all rate codes in the T class proportionately based on their payroll. So collectively, we share in capping. It's a form of collective liability. Eckler said claims cost capping is a necessary part of any rate-making model. However, he said, the way we're approaching it isn't quite right. First, the $90,000 is a fixed amount and has been in place for many years. It's never been indexed or increased based on any changes. Eckler said if you're going to have a claim cap, it should somehow be indexed, have some form of indexing provision, so that as things change, or as we go forward, the claims cost cap should escalate with it. Secondly, he said, it doesn't make any sense that you apply only the methodology to pension costs. It should apply to all compensation-related costs. Eckler recommended that we establish a multiple of the maximum insurable earnings to determine what that claims cost cap should be. So what the board has approved is that we will use 3 times the ultimate maximum insurable earnings, which equates to just under $252,000. That would apply to all claims, not just pensions. The second part of the decision by the board is that the difference between the claims cap, so approximately $252,000, and the actual cost of the claim would be spread across all rate codes at the board level, based on your proportion of claims costs, not payroll. Now we have spread the collective liability across all rate codes, not just a class. If you had a claim, let's say for $400,000, you'll be responsible for the first $252,000, and the other $148,000 would be spread proportionately across all 50 rate codes based on their claims costs. It's important to understand that the percentage of claims that are over $252,000 is less than 1%. So they're extremely rare events in the system. So what would be the impact of this on T42, T51, and T61? Excuse me. So for T42, the impact is going to be an increase in this element, had we implemented in 2017, of 9 cents. The average pension costs are higher for T42 than that was in the T class. So T42's pension costs were higher typically than the average pension costs in the T class. So really they were benefiting from pooling pension costs. That's going to get removed, which is going to drive up the premium rate. Costs in excess of 3 times the max are 70% lower than the board average. Therefore, pooling of costly claims will also increase claims costs for T42. The impact of these two things would be an increase of 9 cents. In T51, the average pension costs are lower than the average T class pension costs. So by removing the pooling of pension costs for this rate code would cause their premium rate to decrease by 5 cents. Now, well, more than 5 cents, because the costs of the 3 times max, so once you consider all claims that are above 3 times max, T51 doesn't have, percentage-wise, doesn't have many of these claims. So they're not really going to benefit from pooling expensive claims a whole lot, which is actually going to increase. The balance of the increase of pooling claims above $252,000 and the blending of the the pooling of the pension costs, the net effect of that for T51 was a decrease of 5 cents. T61, commercial air transportation, would see a decrease of 13 cents. And again, for T61, the average pension costs were lower, significantly lower than the T class. So pension pooling, the old way we did it was forcing an increase in the premium rate for T61. Removing the pension pooling is driving down the premium rate for T61. The next recommendation dealt with fatality costs. Under the current system, we calculate an average cost per fatality for all fatalities that occurred over the last 10 years. And every rate code gets charged the same amount whether they had a fatality or not. The 2017 rates include a 4-cent charge for the average cost of fatalities over the past 10 years. Eckler said that's not good accountability. What we should be doing is we should be holding rate codes that have fatalities more accountable for their own fatality costs. Depending on the credibility of the rate code, we'd look at an average cost of fatalities over the last 5 years. And for low credible rate codes, we'd look at the average cost of fatalities based on that blend of 5 and 10 years. Now, it's important to understand the cost of fatalities can vary significantly. If a single person with no dependents was fatally injured, the costs for that claim might be $10,000, could be burial costs only. However, the costs of the death of an individual who is married with multiple dependents could be as high as $1.6 million over the life of that claim. So in order to recognize the diversity in the costs of fatalities, the board said that they will cap fatalities the same way they cap all other claims. It's 3 times the maximum insurable, which is roughly $252,000. All other costs would get pooled at the board level. So let's look at the impact of this change. T42 had 19 fatalities between 2011 and 2015. The net impact of the cost of those fatalities is going to see an increase of 8 cents in T42. 19 between 2011 and 2015. T51 had 6 fatalities, and we'll see an increase of 2 cents based on the costs of those fatalities compared to the average cost of fatalities across all rate codes. And T61 had 1 fatality between 2011 and 2015, so its fatality costs are actually below the 10-year average, and as a result, they will see a 1 cent decrease in this element to their premium rate. Again, had we implemented it in 2017. Long-term claims. As I mentioned earlier, we can pay up to 50 years under the current model on a claim. And as I mentioned, we calculate a 5-year average, and that 5-year average includes the costs of all claims paid in those 5 years. So in any of those 5 years, and for the 2017 premium rate, you could have claims that occurred 20, 30, 40, 50 years ago. And if they've got costs within the last 5 years, we're going to consider those costs in calculating the average costs for your premium, for your industry. So under the current model, we don't care when the injury happened. If there are costs in that particular year, we're going to include them in calculating your 5-year average. The assumption being that in your industry, you're going to have similar injuries and costs that you had several years ago. Eckler said that's not necessarily true. Many of the employers in your industry have changed. Industry practices and technology have changed. The experience of many employers in your rate code is different and may not reflect the experience of employers today. Eckler suggested that we should use a shorter experience period, somewhere between 5 and 10 years. And after analysis, we determined that 7 years would typically capture 75% of the costs of claims. So instead of going back 50 years in every one of those 5 years that we use to calculate your average, we include in calculating your average claims experience, we will only go back as far as 7 years. So in 2011, we'll include the costs of all claims that occurred in the previous 7 years. The same thing is done for 2012, 2013, 14, and 15. A 5-year period, we go back 7 years in each of those, and then we calculate an average, the 5 or 10-year average, based on the total costs. So we're still going to have to pay for the remaining 43 years worth of claims costs. So what do we do with those costs? What the board has approved is that we would take the remaining costs in those 43 years and we would pool them based on the claims experience of each rate code. We'd spread them across the 50 rate codes proportionally based on their claims experience. So what's the potential impact of this change? If the majority of your costs are in the most 7 recent years, by dropping the 43 years in the calculation of the average, this is going to drive up your average and will increase your premium rates. If the costs in those 43 years is greater than the most 7 recent years, by dropping those 43 years, it's going to decrease your average and drop your premium rate. So in T42, your portion of the 7-year costs are higher than your portion of the 43-year costs. So this is going to increase your premium rate by 3 cents. In T51, your portion of the 43 years was higher than your portion of the 7 years of costs. So this is going to cause your premium rate, this element to your premium rate, to go down by 14 cents. So your most recent experience is better. In T61, similar. Your portion of the 43-year costs are higher than your portion of the 7-year costs. So your premium rate is going to go down for this element by 7 cents. The next recommendation had to do with the way we allocate administration costs. So our administration costs, like all organizations, are divided into two basic categories, fixed and variable. And the simplest way to think about this from our perspective is variable is all costs associated with dealing with claims. Fixed costs are all the rest of our administration costs. IT, HR, establishing premium rates, registering employers. So whether or not whether or not there was a claim, these are activities all employers would have to participate in, and or the basic infrastructure we'd need to run the business. So our variable costs are all of those who work on claims. Under the current model, we assume that 10% of our costs represent our fixed costs, and the remaining 90% represent our variable costs. The 10% fixed are allocated across all employers based on their percentage of payroll. The 90% variable are allocated across all employers proportionally based on their claims costs. Eckler said that this is a great approach, but we should make sure that the percentages are right. And that caused us to undertake an analysis and actually divide our costs into the fixed and variable categories. When we completed the analysis, we determined that our fixed costs are actually 30% of our costs, and the variable costs represent 70% of our administration costs. So we've adjusted the fixed component from 10 to 30, and the variable component from 90 to 70. And in looking across some of the other jurisdictions, the 90-10 split that we had seemed to be a bit of an outlier. Alberta, I think, is 75-25. Ontario is 50-50. So that 90-10 split was more of an outlier compared to other jurisdictions. The analysis of 70-30 would suggest that's probably more typical of what's happening out there in other compensation systems. So what would be the impact of making this change? In T42, the administration costs related to variable, so claims-related costs, would have went from 82 cents down to roughly 62 cents. The fixed for all rate codes is going to go from roughly 3 cents to about 10 cents. So the net impact of that is for T42, the administrative costs that were built into the premium rate would go from 85 cents down to 72 cents, which is a 13-cent decrease in this element of your premium rate. For T51, the variable costs associated with claims-related activity, managing those claims, would have gone from about 30 cents down to 19 cents. Fixed would have went from 3 to 10. So the net impact of that would have been going from 34 cents down to about 29 cents, or a 5-cent decrease. And in T61, the variable costs would have went from 22 cents down to about 14. The fixed costs from 3 to 10. The net impact of all that would be going from roughly 26 cents down to 24 cents. So a 2-cent decrease. So when we roll up all of these changes to the model, what does it mean at the end of the day? What would have it meant had we implemented this in 2017? For T42, the impact would have been from $3.18 down to $3.01, which is a 5.3% decrease, or a 7-cent decrease, 17-cent decrease. In dollar amounts, that would have been a decrease. We would have required about $1.1 million less in premiums. There are roughly 5,700 employers in that rate code. It would have represented an average decrease of about $200 per employer. For T51, the net impact, the net change would have been from $1.28 to $1.01 had we implemented. 21% change, a 27-cent decrease. The net premium impact of that would have been about $450,000 less in premiums for the whole rate code. Now there's only 27 employers in that rate code. So the average decrease would have been around $16,000 or $17,000 per employer. T61, commercial air and transportation. The changes, had we implemented the changes, the premium rate would have went from $1.01 to 75 cents. A 25.7% decrease, or 26 cents on the premium rate. The net impact of that on premiums would have been a reduction of about $320,000. There are 108 employers in this rate code, representing an average decrease of about $3,000 per employer, just under $3,000. So next steps. Today's presentation, as all of our presentations that we've done, are being recorded, will be available as a webinar on the website, on the WCB website at www.wcbsas.com. And they'll be available there in the future if you want to review this information again. What we've presented here is quite a bit of information, and you may need to think on this for a while. You may have questions well after the presentation here. If you do, we've got a mechanism. There's, you can send it to askwcb@wcbsas.com, any questions that you have. We'd prefer that you send your question through there because we're tracking all the questions and looking to see if there's common types of questions that we can maybe put out FAQs or provide more information to employers as we go forward. But we're also looking for feedback on the transition of the impact. So I gave you the total amount of impact, and just as an indicator of what might happen in 2018. That's not for sure, it's just simply because the experience is going to change. Every industry's experience is going to change. The impact of that could be up or down, but you get a sense of what it might be. So as much as there are, as you've seen here, some rate codes going down, there are others that are projected to go up. The net amount of the premium rate or revenue that we need is no more, no less. When we ran the new model, the average premium rate still came out at $1.24. So even though these rate codes would appear to be going down next year in terms of premium rate, there are others that are going up. Because at the end of the day, we just need the same amount of revenue. So we're asking for employers' feedback on the transition from the current model. What's the transitioning the impact from the current model to the enhanced model? And we've got a section on the website at www.wcbsas.com/feedback where you can complete a survey and or provide any ideas you have about transitioning the impact. Because once we've transitioned the impact, it's a one-time transition. From that point forward, it's the industry's experience that's going to dictate their premium rates. That feedback will be open until April 7th. We've given you a couple of choices on there. One would be to implement it all now for 2018, transition it over a couple of years, so we'd split the amount and transition half of it in 2018 and the other half in 2019. And then we've left it open for any other ideas that you may have in terms of transitioning the impact of going to the enhanced model. Final slide of the presentation. It's important to highlight how important injury prevention is. WorkSafe has been promoting injury prevention, and since 2008, we've had Mission Zero out there promoting zero injuries, zero fatalities, and zero suffering. We all know the best solution to managing claims costs is preventing the injury from happening in the first place. I want to personally thank each and every one of you, because we know as businesses you're working hard to identify and control hazards, prevent injuries, managing those claims. And you're helping make Mission Zero a reality. In 2016, 88% of employers registered with WCB had zero injuries. Last year, in 2015, it was 87%. It was lower the year before that. So for the last few years, the percentage of employers achieving Mission Zero has been steadily increasing. And that's due to the hard work of companies like yourselves. And we appreciate it. So with that, I will now open it up to any questions people may have related to the presentation. Any questions online? None? Today is not your only opportunity to ask questions. Like I said, we kind of figured some people might need to think on it. And if you do, by all means, send the questions to the Ask WCB. And we do want your feedback on the transition, the impact of the transition from the current model to the future, or the enhanced model. So if there are no questions, I'd like to thank everyone who participated, came out today, and those that joined us online. We really appreciate your participation in this. It's important to us, and we look forward to your feedback. Thank you, and have a safe day.